Doris, I'm here to show you about market updates. Investors began to sell short-term bonds, and Wall Street bigs are warning that a recession is looming. Japanese bond yields on Monday short rise and long fall. The yield curve significantly flattened. The Bank of Japan's next policy meeting will be held on June 15th to 16th. Some investors have begun to expect the yield curve to control plan or adjustment. The short bond selling is more obvious. Late on May 29th, the 10-year yield was 0.435%, up 0.8 basis points. The 3-year and 5-year yields were up 0.6 basis points and 1.2 basis points at negative 0.04% and 0.105% respectively. The ultra-long end varieties were strong, with the 20-year and 30-year Japanese bond yields at 1.03% and 1.265% respectively, down 0.6 basis points and 0.8 basis points respectively. The Bank of Japan's earlier released its financial report of fiscal year 2022, with net income of 2.09 trillion yen at the end of March, with unrealized ETF gains of 16 trillion yen and outstanding loss of 157 billion yen. As the news, Mr. Utada said the high cost of premature withdrawal of stimulus was extremely high. Utada, the first president to run the Bank of Japan as an academic, was widely known for his vote against raising interest rates and ending a zero-interest rate policy when he was policy commissioner in August 2000. Speculation about this year's policy changes continues, with economists at Goldman Sachs and BNP Paribas expecting the Bank of Japan to adjust its yield curve control plan in July. Societe Generale said the yen would rise about 7% in the next few weeks, citing the Bank of Japan showed signs of raising its cap on interest rate bond yields at its upcoming meeting. Elsewhere, Mitsubishi UFJ Financial Group recently issued a 570 billion yen worth of bonds, making it the largest yen bond deal in Japan this year. Underwriter Mitsubishi UFJ Morgan Stanley Securities said that as yields rose, the permanently non-redeemable 10-year and 1-month AT1 bonds offered a coupon of 2.127%. The deal is the second time since March that a large bank has issued AT1 bonds in Japan. Demand for Japan's AT1 bonds is likely to remain strong, as the risk of a technical bankruptcy is lower than in Europe. Sumitomo Global Marketing Department manager said in an email. U.S. stocks have maintained a good rally this year, which is incompatible with growing recession fears in academia and industry. But according to Wall Street experts, U.S. stocks are standing at a crossroads, and this year's rally may not last long. A number of top analysts have warned that a sustained sell-off is likely to occur in the coming months, with the S&P 500. Many people pointed out that the main driver of the U.S. stock boom this year is the hype of artificial intelligence concepts, with the rise of big technology stocks thus creates a thriving atmosphere. But in fact, the S&P 500 gains this year have not been spread across a wide range of industries, and this imbalance hides signs of the deep recession. Mohammed Al-Arian, top economist and chief economic advisor at Allianz, pointed out that a handful of tech stocks are still doing well this year, that the Nasdaq wouldn't have outperformed the market without NVIDIA, and the S&P 500 should now be on its way down. Manish Habra, head of U.S. strategy at Societe Generale, said that AI boom and the hype is an important factor supporting U.S. stocks, and without AI stocks, the S&P 500 is expected to fall 2% this year. The shadow of prosperity. Professor David Rosenberg, the founder of the Rosenberg study, notes that the transportation, consumer discretionary, and banking have fallen sharply this year, as they did in the recession of 1990, 2001, and 2008. However, Rosenberg did not explain its data source. According to the S&P 500 Industry Index, the transportation and the consumer discretionary have still shown positive returns, which leaves Rosenberg's warning as a crying wolf story. But the head of tech stocks, thus contrast to the lightness of other industries. Liz Saunders, chief investment strategist at Charles Schwab, said the S&P 500 had been higher in the past few months, but the consumer discretionary rally has not kept up. She also included a chart with the blue S&P 500 versus the yellow non-essential index. Fidelity's Korean Timur, China's global macro director, sees another perspective. The top 50 companies in the S&P 500 are irrelevant from the bottom 450, suggesting the U.S. rally is fading. And Larry McDonald, founder of the Bear Trap Report, an independent investment research firm, also warned that the S&P 500 could plunge nearly 30% by December as falling the corporate profits, lowering government spending, and banking turmoil pose the risks to the U.S. stock market. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.